Up of the current market situation. The 12% returns from equity seems like a fairy tale right now. People who started investing in September of 2024, they've seen bad years where like the money has not moved upwards at all, and probably they piled up on some losses. But does that mean equity as an instrument has lost its edge? Not really, because like it is quite dynamic where you earn money some years while your money does not do much in some years, and it is completely about compounding. But that does not mean that you do not invest into other means which can help you like get some returns on your investments while equity market is not doing much, because you need to pay the bills, you need to do some travels, you need money for things where like cash flow is important. So let us look at some fixed instruments which like which can help you earn interest from 9 to 12%. And yeah, how do you invest in them, all of that. So let's like dig right in, and please subscribe to the channel and share with your friends. It will really motivate me and help me research more for such videos. So yeah, why fixed return instruments and what are they even? So fixed return instruments help secure cash flows in bad market. You need money for like certain things. If you need to travel regularly to your hometown, if you're in a corporate job, you need money for weddings, for buying stuff, for shopping, for like planning trips for parents, and a lot of things. And a consistent cash flow is important, and it's good if that comes via your investments as well, rather like other than your salaries. So bad markets are like sideways market where buying opportunity is not instantly visible. Either the equity market is very highly valued, the PE is very high, where buying at the current point does not make sense, or it's in a like there's no momentum at all where like the market is not moving up at all. So you need to wait for the right time to invest so that you're not just caught up in a loop where like for 10 or 12 months your money did nothing at all. So equity markets are uncertain. Fixed return instruments are great for emergency funds. So like say I am not sure where to invest right now because the markets are not doing great. So for that time, if like I keep my money parked in my savings account, that's not going to yield me much. Savings accounts are usually like 2 to 3% per annum. So that return does not even beat inflation. So some fixed return instruments which are like better than the savings accounts need to be utilized in such periods. Also, fixed return instruments allow a more passive approach. When you are investing into equity, you are stuck to a screen. You need to look at like how your stocks have been performing, if not daily, at least on a weekly or a monthly level. And yeah, that brings in some stress. Mutual funds are less stress, but like when you see the markets going down, it becomes more of an active approach than a passive approach. So let's look at like different fixed return instruments. So where to invest money when equity market is stuck? So some fixed return instruments are your bank interest, like usually the salary accounts or the savings account pay you 2 to 3% interest. Some small banks or new age banks like IDFC Bank pay you around 7% interest, but that is above a certain limit. So if you're keeping money like above 5 lakh rupees to a certain limit, on that you'll be earning that 7% interest. Other than that, you'll be earning 2 3%. Then there are debt mutual funds which like basically uh, invest in bonds or like different kinds of debt related entities where you'll be earning around 6 to 7% like returns. There are some different kind of debt funds which earn you around 9 10% returns. I will talk about that later as well. Then there are bank FDs which depend a lot on the repo rate. So at times like last year it was giving around 8.5% interest as well on like an annual level, but currently it's around 6 to 7%. Then comes the major topic of the video today: unlisted bonds, a space where you can expect returns between 9 to 12%. So let's learn more about the unlisted bonds. What exactly are unlisted bonds? So think of it as simple as you giving loan to a company. So say a big company like Navi or Muthoot comes to me and says, I want a loan from you. So in return, they register like they basically create a certificate which is called a bond, and they give it to you, saying that okay, this person has given me this much debt, and I'll be returning the money in this many installments, and finally the principal amount. So this is something, this particular certificate or the bond is like given and like saved in your demat account. A separate demat account is usually created for these bonds. So this is form of a debt which you give to a company, which is validated by this bond, and there's a specified period where the money will be returned to you by the company with a certain interest, and like the principal amount will be returned in that particular tenure as well. So basically this can be something like if it is a 24-month bond and they say that they'll be paying you interest monthly, so you'll be getting interest for those 24 months. And if it is like the payment of the principal is at the last, so you'll get your money which you invested after 24 months. Or the principal payment can be staggered as well, where you get half your money after a year and half at the end of the 2 years. So there are options like that. So the debt usually comes against a collateral. So basically when they register, when they issue these bonds, they also give collateral to basically become like a bit secured here, that okay, this is against this given collateral. So the bonds are also rated, so you need to understand how stable those bonds are. Like when you look at companies, there is a different stability thing. When you look at mutual funds, some are like the equity mutual funds are high risk, while some other funds are not as highly risked. So here the investable bonds range from triple A, which is like the highest rating, to AAA and BBB rating. This depends on like financial stability of the company issuing the bond, and even like the regulatory regulations around in the industry. And this rating keeps on changing on a quarterly or a bi-quarterly basis when analysis is done. So yeah, let's look at some fund bonds now. So okay, let's look at a few bonds. So we'll be looking at a platform called Wint Wealth. So similar to Zerodha or Grow, this is a play like in Zerodha Grow where you buy shares. This is a place where you can invest in bonds. So they list bonds for you, and this is via demat account. So even if this Wint Wealth goes away, your bond is in your demat account, and you'll still keep on earning interest. So that is independent your of the place you're like registering for this. So they Wint Wealth in general create a curated list of bonds where they even invest 2% themselves in those bonds, and create a list where they think these bonds are like investable bonds and have good collateral and things like that. So you can look at like live bonds. There are not a lot of options usually. So there are 31 live bonds right now. Something called Purple Finance 5, where like maturity is shown as 26 months, interest will be earned monthly, and principal is staggered 11.25%. Spandana, Midland Microfin, a lot of these. So let's look at a couple of bonds. So Navi is usually a famous name if you're into the tech world or the finance world. So this is one bond where like YTM, you'll be getting earning 11% interest, and the maturity is 20 months. Minimum investment amount is 10,000, and the rating is A, so it is an investable bond. And this even shows you like how the interest will be returned to you. So if you invest rupees 50,000, that is 5 bonds. So in that case, you'll be like earning monthly interest of rupees 437 this month, 395, and in the end, you'll be like earning the principal amount, that is 50,000 rupees. And like you can increase the number of units here as well, and like the returns change that way. So this way, if you're investing 60,015 rupees before taxation, your total returns will be 70,616 rupees. And you have two options: either you invest in the 18 months bond, which gives you 10.75%, and 20 months bond, which gives you 11%, so higher for the higher duration. Let's look at another bond. So this is Midland Microfin. While we saw Navi was rated A, this particular bond is rated BBB plus. So it yields you a little higher interest, which is 11.5%. But like the minimum investment amount here, a single unit costs around 1 lakh rupees. So that is something to be accounted for. So if you're investing 1 lakh rupees, your total pre-tax returns will be around 1 lakh 16,508 rupees, and you can increase units, and similarly the pre-tax returns will change. You can look at like interest. So when you are getting 2 units, interest will be like 1,700 or like 2,000 rupees coming into your account on a monthly basis, and like the principal amount, which was 2 lakh rupees, coming into the end when the bond matures. So this is about Wint Wealth as a platform. This even allows creating bond SIP, so you can diversify into different bonds, and then you can like earn a little extra. They provide you 0.5% extra. So their model is usually that they give you curated bonds where you can invest in, and like they usually keep a percentage of the returns. So and they, while they also take some risk, and they invest 2% of the total bond amount. Now let's look at some other things which like the platform provides. So you can see that okay, this bond has a security cover of 1.10x. So this is the collateral. They show that 2% is invested by Wint Wealth itself, then the other debt investors. So in this case, SBI has invested into this bond, IDFC Bank has invested, and Bandhan Bank has invested. So then you can look at things like comforts and risks. So this shows you that what like the analysts that work at Wint Wealth like about this. Basically, they've done an analysis of this particular bond. So established presence in the area of operations. You can like read some details that the company has presence in 224 districts with a network of 570 branches, demonstrated fundraising ability, modest albeit improving capital structure, and there are some risks as well. Flat growth rate and AUM, moderate asset quality, inherent risk in microfinance segment. So then to the microfinance wing, you can look at like taxation details and other bond details like the financials, ratings, documents, like things like this, all of this. So this is the platform. Yeah, let's look at taxation in general. So the interest is paid to your account, and similar to FD, like when you look at FD or your bank interest, it is taxed at your slab rate, which can go up to 30%. So this is not equity taxation. The interest that comes to your bank account can be taxed as high as 30%. So like if you are getting a 12% return, this can drop down to around 9%. uh, when you look after tax. Profits from bond sales. So say I bought a bond for 2 lakh rupees and I sold it for 2 lakh 1,000. So that 1,000 profit, that is taxed based on LTCG or STCG. So if you sold the bond after 1 year, you will be taxed LTCG, that is 12.5%. Otherwise it will be 20% for STCG, but the interest will be taxed at your slab rate. Now, yeah, so there are some certain mutual funds which kind of mimic this behavior, not just unlisted bonds, different like GSECs, government bonds, listed bonds as well. So credit risk debt funds are like the ones that invest as well. Since these are debt funds and with the new taxation rules, the short term capital gains are still taxed at 30% in short term, but in long term, like you'll be taxed based on equity, and that is 12.5%. So that is one good thing. But you'll see that the returns with these bonds are not like closer to 12%, they are closer to 9%. So in the end, like when you look at returns after tax, it becomes similar for credit risk bonds, mutual funds, and like the usual unlisted bonds. But one important thing is that in the creditors debt mutual funds, whenever interest comes back, it is reinvested. The NAV of the fund or the AUM increases, and that is reinvested. But when the unlisted bond interest comes to your own account, it is on you to like invest that back. So that is something which is different. Now look at one of the credit risk funds. So this is ICICI Prudential Credit Risk Fund. If you look at returns, so let's look at last 1 year, which is 9.67 CAGR. Last 3 years, 9.04%. Last 5 years, 7.96%. So you can look at things like expense ratio. So this is 0.76%. So this is one difference as well. So from this 7.96%, you'll have to reduce this 0.76%. So 5 year CAGR was essentially 7.2%. And then like it will show you things like cash holding, how much cash is it holding, what is the credit risk, the AUM, and like exit load. Usually these funds have exit load. So in case of this ICICI fund, exit load of 1%. If you sell more than 10% units, you'll be charged an exit load of 1% of the investment size. So yeah, this is the thing, because they are like investing in bonds, and they'll have to take out that money if like the redemptions are a lot more than the cash they're holding. That comes with certain they'll have to get rid of those investments. So that is why the exit loads. Then you'll see cash holdings and like the other investments. So companies that they hold: Government of India, Vedanta, Embassy, Keystone, Realtors. You can like view all the companies here, the bonds they've invested into. And then the instruments that they're holding, like GUI, Government of India securities, and REITs, SDLs, debentures, NCDs. Yeah, so all of that. And the riskometer is high. Usually for equity it's very high, but for this credit risk one it is high. So this was mostly all about the video. Let me know in the comment sections if you have any doubt about these unlisted bonds or mutual funds, the credit risk mutual funds, and do let me know any video suggestions that you want to see next, and any just suggestions in general about the videos on the channel. And please share this with your friends and subscribe to the channel. Thank you for watching.